right. Well, greetings. I am very excited. I have got Macro to Micro Power Hour featuring Women in Trading and Finance series. I'm very excited to be joined by Brynne. And Brynne Kelly is an energy analyst. I am, by the way, Samantha LaDuc, founder of LaDucTrading.com. Most of you already know that because you follow me on Twitter or Brynne and you want to get a little bit more insight into her take on the oil and energy markets in general, but also, stories from just working in a very strongly kind of male dominated industry, not just energy, but financial services. So we're going to talk some stories as well as the market. And welcome, Brynne. Thank you so much for joining.
Well, hello, Samantha. It's nice to finally meet you.
I am just sharing this particular picture here because this is what we put out to say, hey, we're going to be talking about women in trading and finance, and then of course energy markets are hot as it relates to just lots of speculation right now and lots of movement all over the place. But first, let me introduce you and then give a little backstory about yourself as well. I found you on Twitter, and I'm going to share that screen again so I can kind of properly. This is Brynne Kelly's Twitter handle, just like her name with an extra K. And I was recommended to you by an energy analyst, oil analyst named Robert McMinn. He's not on Twitter anymore, but he is someone who I've had interviewed before. We talk oil and obviously trading it. And I wanted to obviously bring in more women to the spotlight. So your name came up, and I'm very glad to meet you. And I want to do honor to introducing you as Director of Research at Cornerstone. This is actually your website.
Cornerstone Futures, yep.
Yep. And then you publish a blog post, a very good one, on Cornerstone, Global Commodities website. So I've got both of these. I'll put them in chat as well. And basically just want to remind folks that when this is over, a little housekeeping here, because I do this every Tuesday and Thursday, I post the webinar interview podcast, if you will, right in on my LaDuc Trading YouTube channel. And you'll see I've got Power Hour, Insights, presentations, and then Women in Trading and Finance right down here. You can kind of tell it from the orange. And that's where this interview will be posted afterward. So there we go. I'm done with the housekeeping. Why don't you tell us a little bit about yourself and how you got into becoming an oil consultant and analyst?
Sure. Well, I grew up in Minnesota, and I went to University of Minnesota, graduated from the Duluth branch. I had a degree in finance, and living in Minneapolis, right out of college, I went to work for Cargill. And was plopped right down into their what's called financial markets division. And, it's what it sounds like. It was the huge fund, financial trading business for Cargill, separate from the energy, the agriculture and all that, commodities, corn. It was financial markets, and they traded baskets of stock on the Nikkei and the Topix. And I was kind of put into what you would call like the middle office. And I didn't know anything about trading. I didn't know anything about the industry. And I was like, from the minute I got there, I was just fascinated. My father is a CPA, so I didn't really know anything about this whole world of a trade floor. And one day some trader came out and yelled at whoever was, like doing his P&L, and it just, went crazy, screaming at him. And the girl didn't cry. And my boss said to me, that's the measure of how you make it in here, is if you can take all of that and not cry. And I was like, note to self, okay, that's what you got to do. And I just worked my way over the years. I wanted to get on the trade side. I wanted to be trading. Of course, I didn't come from a family that really had any connections in that world. I didn't have, a mentor or anybody really that I could pull from, or that would suggest what this world is.
Not
And
to
so I
mention the
kind of,
fact that if your dad, a CPA, that's kind of risk averse. Trading
yeah,
is a very different animal, and a lot of those who are into just the regularity, if you will, the predictability of something they can control, do not like trading, do not like trading careers. I wonder how that went over.
certainly he, as a business owner, he owned his own business.
Oh, okay.
So
Yeah.
there's some, like element of risk taking, but you're right. The activity, as a CPA is a fairly, it's just different.
Yeah.
It's just different line of work. And, I had to figure it out myself and figure out how would I get this elusive job as a trader? I saw it, I was working, right around it, but I was not the trader. And the middle office, let's just say, isn't typically where traders, pull from, where the desk pulls from. They tend to pull, someone from their scheduling group or somebody that is actually working, directly with them. And so I spent a lot of years moving around. I went from Cargill, then I took a job at another fund. It was a group of like portfolio managers that left Cargill and went and started their own fund. And I thought, well, that'd be smaller and, be a closer avenue in, but it was small and I didn't, it wasn't going to happen. So I went to Dane Rauscher, it was called at the time, as a regional broker in Minneapolis. Dane Bosworth, I think it was called. And I ended up being the assistant controller of this, it was just, I was coming up in a lot of different ways in my career. And I thought, all right, well, maybe I'll do that. And then I can get, into the IPO road shows or something, some way that I could find my way over there. And then as chance would have it, I was married. So I got married out of college. We moved he was transferred to Wichita, Kansas. And then I ended up getting a job at Koch Industries as the assistant controller in their supply and trading business. So that was my first foray into all of the commodities. And it was excellent experience. I got to interact at a really high level and understand all of the physical characteristics of energy, because, the trading strategies there at the time were very physical in nature, moving barrels and product around the country to capture spreads and, differences in location pricing, grade pricing, blending components in a tank, to have, create finished gasoline and all of the economics of that. So that is
Brilliant.
kind of,
That's really
right.
detailed.
Yeah, I got to
experience.
cut my teeth. And then finally, I ended up getting an offer from an electricity utility in Kansas City that was starting up an electricity trading group. And they interviewed me and they said, you know what, we pride ourselves on picking people that we think would make great traders, and we think you would make one, and we're going to give you a chance.
Wonderful.
So I went back to Koch and I told them, they made me, an offer to move into the oil trading business. And this was one time I got some advice from a guy on the desk, which one should I pick? And he said, pick electricity, because in oil, and keep in mind, this is the 90s. So you'll be shoved on the weakest accounts, given the lowest customers, it's a very old boys network. Go to the emerging new industry. And because, it's anything goes there. And that's what I did. And from, I think it was 96 on through, for 20 plus years, I worked at various companies, BP, Sempra, Aquila, trading electricity and then moving into natural gas and oil. And as a result, today I just see it from so many angles that it just naturally sort of the assessment or the analysis just happens. Because I don't, when electricity started, there weren't charts. When we were trading electricity forwards before they were even futures, you weren't relying, there was no exchange. So, it was all over the counter, voice brokers and back and forth and, what your gut was and what you thought and really taking advantage of dislocations, right? Moving power from one state to another, moving gas around, buying firm versus non-firm, all the things that, kind of middle marketing does within the market. But all trading, not having any assets. And it was great. It was a great way to learn.
Every angle.
Yeah. Electricity settles, a real-time price every 5 minutes and it trades every hour. So there's constantly someone, what are you doing next hour? What are you doing? So the granularity that you get to see, it's easier to go up in granular, once the details to kind of move up. It's hard to, if you don't even know these details exist, to kind of uncover them.
So what made you leave that? Just the time had run its course. You wanted to go and when did you go out on your own?
Look, one thing I thought 100% for sure when I left that assistant controller job at Koch Industries, when you're stepping into trading, you are stepping completely off of the career path line. It is a risky.
I'm about to say dead end, but at the same
it's
time,
not a dead end. It's robust in a different way, but it's also look, you're going to make money, you're going to lose money. Companies are going to have personalities and reallocate capital different places, and you can sometimes just get caught up in all of that. So for the most part, usually it was something changed, right? So you just roll with it. And when I left Millennium, or when that kind of mutually ended, when I was portfolio manager at Millennium in New York, it was in 2015 or 14, right when oil was crashing. And that first time, obviously not, it was pre-pandemic. It was really everybody was, shoring in, and I'm like, you know what, I'm just gonna kind of lay low here for a little bit, start writing, and that just has blossomed from there. And but I didn't set out that way, but here we are several years later, and I've been doing consulting across the world, a great partnership with Cornerstone Futures and all of their oil brokering. So, you just kind of end up where you end up.
but this perspective that you bring from, very tactical trading, and then all of the exposure that you had to the different, sectors within the energy market, plus, middle office, trading office, portfolio management, this gives you that depth of perspective. So in your writing, I can see you have, you're not just linear, you're really able to scan and synthesize a lot of different kind of data points and bring it together. There's a good flow, if you will. It looks very thorough.
Well, thanks. And it's interesting because I see that you do a lot of technical work and kind of looking at what is the price action telling you. Mm-hmm. And I do a similar thing, except for mine is looking at the price action of relationships, not of a technical chart move, but more is this relationship, as it's widening out, what does that mean? And at what point, is is someone going to come in and arb that out, and various, and so it's in a different way, but I do derive a lot from price action, but not,
But it's
price
but
action.
you have a fundamental understanding, of the underlying that I do not. And this is, one of the reasons why I've been friends with Bob, the past few years as well, because he just trades oil. And
Yeah.
so your specialty, I seek that out, right? Because I'm all asset classes, across the board.
Well, you can flip around to what's hot when
I
you do
can, and
that, right?
that's my value add is I'm looking
Yeah.
for momentum. So it's to
Yeah.
anticipate through relationships, but typically it's my kind of intermarket analysis, a little macro, but not the deep dive in fundamentals. From where you come, that you can really understand it better, and that power to me is a great perspective. Then I match it with what I'm seeing in the price action to see if it's aligned. And I like it when totally different perspectives come at it and reach the same conclusion. And also divergences matter too. What am I missing? So I love that exercise. And I think women are a little bit open to doing that. Flexible mind. At least I know. Sounds like you're very curious.
Well, I mean, that's why I post on Twitter, right? I mean, I'm
Yep.
really honestly
Engagement.
just looking, I'm not looking to be the rightest person in the world, but I like the chatter.
Yeah.
If I'm looking at this and I put it out there, I kind of see if I get what reaction do you get?
Yep.
It kind of tells you a lot of the kind of tone in the market.
Absolutely. And it also you form a community. I think of maybe sometimes to be challenged, sometimes to have a theory tested. But definitely, I think you form a community of like-minded for the most part. They value and they respect and they get this, and that's kind of cool, especially in the time of COVID and all the rest, where we're not really by a water cooler. I wasn't anyway before that, and it sounds like you've been on your own. I mean, in partnership or in supporting with the Cornerstone in with your blog, but I'm just
I've been with Cornerstone for a year and a half, and you're right, we've been officing from home
exactly
since last March. So
exactly. So there's no more like side by side or kind of communication. It's definitely social communities online. So for lack of a better word, but you have this market perspective that you write about, and how often is it just intermittent, or do you have like a
every
regular?
Sunday.
Every
Every
Sunday.
Sunday is, if you go to the Cornerstone Futures website, you will find the weekly market blog. And that is, a Cornerstone, is a major oil brokering firm, right? And so it's going to clients around the world and some of the, bigger players. And in that way, it's good to get the pushback or to, be able to, kind of crystallize these ideas, right? Through what, actual people out there are looking at.
So you're doing the written analysis. What do you miss from actively, portfolio managing when you were at your former firm?
Oh, I mean, just immediate feedback, right? I mean, that's the best thing about trading. You just always know where you stand.
Oh my gosh.
I think about
Good, bad, and ugly. Yep.
in the beginning of my career, sitting in some meeting, and we're talking about, I don't know, whatever, right? Just how we can increase, communication or something. And I'm just like, that's not my thing. I want that. I want to just know, right? I'm up, I'm down, I'm up, it's so black and white. And I like that nature of it. So I miss that, not to say, I don't, have, various ways in which I participate. But this is a little bit more, you might have an analysis that you put together and it takes a while for it to, come to fruition. And, and then for people to remember that you said it is, the feedback is a little different.
But that is the difference also when you print, right? You have a timestamp on your analysis, and that is
Right.
a track record of not only your calls, I find it anyway, but a way to reference back to the quality of the calls So that's important. And it kind of forces better trading to step back and do that written analysis, at least for me, because I know it's going to be read and I'm going to be held to it. So I
Yeah.
don't want to print it unless I feel really convicted about it. So you're doing your analysis now. Obviously, you have very few restrictions, right? So in other words, this not answering to clients per se. Um,
No, I mean,
but you're engaging with clients. I mean,
yeah, this
I mean,
is
versus managing
separate
money.
from, yeah, this is a, a service offered. And, what I like to think of it as, I'm not so much a person that makes like buy this, sell that outright calls. I'm more of I gave you all the knowledge here and the ways to maybe question it.
Yep.
And if this happens or that happens or that happens, now because I don't know what you've got going on in your book, I don't.
This is true. So do you approach this also from kind of a risk aware situation, or in other words, in your analysis? I know that I do with clients. I'm very much this is what could go wrong. So it's not just always going to work out. In fact, it's 100% injury sport. There are so many times it won't. So here's how to protect. Here's what to look for if it's going to go against us, kind of thing. Do you think with that kind of risk aware type of client
I mean,
support, or is
certainly
it?
you spend your whole career governed by VAR, right? And you have to think about that. Everybody has a different risk level. I think try to give them enough tools to assess that for themselves.
Are there any particular markets you like to cover more than others, especially? I mean, some are just very dynamic. What's also going on with the pandemic, the demand, and such? I mean, Suez Canal, when that all erupted, were you worried, or do you like, nah, it's not going to be, it's going to be a blip?
Well, like when news hits the market, like the Suez Canal, right? Or we talk about the winter freeze that we had in Texas in February. I mean, of course, you're trying to figure out what impact would that have, right? And specifically on the Suez Canal, you really had, both ends of it, there's movements both way through this canal. And, the first thing that everybody looks at is the spread. So Brent to Dubai, right? Because Brent crude is on one side of the canal and Dubai is on the other. And really that spread didn't move much at all. And then you look at, the WTI Brent. I mean, everybody is trying to figure out which side of the equation on across that global sphere will be impacted. It's less about, does that make the price go up or down? It's more about what will be the dislocation, how long will it be, will it mean revert? If a spread blows out because of it, once the issue is resolved, will it come back in? And there was a lot of that in the Suez Canal. I mean, people obviously originally just want to think about, oh, price should go higher, and there's kind of some
And it didn't.
element to that. I mean, it was up and down, right? But prior to that, we already had a narrative that was building of these massive time spreads across the curve. And so, people were positioning and have been positioning for the OPEC meeting and for things that were happening. And the curve has, kind of disappointed some people on a lot of those spreads. And really, we just got to a point where they were at, I think the 12-month spread was above $7. And, that maybe happened in 2016, there's a lot of, it's not bearish, but we need to give these room, right? We don't have the next piece of news that will be driving us.
So
and that's kind of where we're getting to, right? Is what's that?
what is that?
It has a bullish structure, but with the backwardation across the whole curve, we have the 3-year strip at like $55. So that's recovered nicely into a range. And now it's just a matter of, should the 1 month calendar spread be 20 cents or $1? It's more vulnerable now to hiccups, these calendar spreads, right? Because we've kind of spent a year adjusting to this new normal and pulled a lot of levers and, got some stability back in the market. And so now it's just a matter of what going forward will impact these. And, and there's kind of nothing, the spreads collapse a little bit, the calendar spreads, right? And then when there's, a little agitation like the canal or winter weather, then they kind of blow out again. And I think we're going to see quite a bit of that.
So you think it's going to be volatile, for lack of a better word. You predict that it's going to be volatile for the next few months? Is this
I think
because of the infrastructure that Biden is proposing? I mean, all the stimulus around infrastructure. Like, what do you think would be a catalyst to get it up and over $65, for example, which would be hard to do, right? Jumping the shark, and get it in so that it stays and producers get interested. What do you think would be more? I
mean, a 3-year strip at, if you look at the continuous WTI 3-year strip, it spends most of its time between $50 and $60. And it's right at 55, right? So, there's some backwardation, right? The front is a little higher. From here on out, we need, we overshot when the pandemic first hit and everybody was pulling back and, it was chaos and barrels that had to, kind of physically find a home, and we way overshot to the downside. And, now we've backed off refining and pulled off production and kind of worked our way through that. And have we found the right price? I think that's what the market is trying to figure out now is, at $60, at, 65, is that going to give us some stability? And so I think we're going to go test, lower 50s and, up above, 65, back and forth.
Okay.
As we absorb some of this new oil that is coming, from OPEC and Saudi Arabia, and we see if the demand is there. We haven't had a lot of data points this year. We started out in January and it kind of looked like pretty setting up kind of bullish, things were kind of coming back online and we were drawing down crude. And then we had the storms in Texas, and it really backed up crude oil and inventory in the Gulf Coast and created a huge draw out of refined products. And, now we have to kind of see that work its way back out of the numbers. So we don't have a great picture yet because there's been so much variability this year. And now OPEC adding more gradually to the market. I think we have to see if at this price level, demand shows up, if production, stays disciplined. And in that way, we're much more vulnerable to a short-term spike up, right? We're kind of operating, the system was harmed over the last year. Just overall, the system was harmed. And whether it's delays on decisions, spending, corporate goals, even it's changed, it's different. And I'm not sure if we have some issue this summer. There's a lot of political unrest. There are a lot of things going on, globally. I think in the short term, we're much more vulnerable to an upside spike. And I think that's why a lot of people like owning these front calendar spreads. But in WTI, every month they've been expiring flat or contango, and it just drags down the resolve of the whole curve. And so, I think we're a little bit of a reset.
So on the spikes, though, I mean, three things that pop into mind. Obviously, the drone attacks. It's very brief. They get knocked down immediately, so it's a knee jerk reaction at best.
Yeah.
Any Middle East tension that you're particularly alert for. If you read about, you're like, yeah, that's trouble. Any particular country of interest, I should say.
Not really my,
Not really. Okay.
not really my thing.
All right. So
To dig down into the individual. No, I think that there is an event that could happen. You've listed some things, right? And who knows, what they may be.
That's on the worst case. I mean, obviously, and conflict and that type of disturbance, if you will, and political as well. On the Biden administration's push for stimulus, which is very much to push consumer demand, also should drive some more spending, if you will, in the energy markets and travel and reopening and all that. Do you think that's really priced in? That's why it's also kind of recovering and going to chop around here for a bit in that, for WTI 55, 65 area? What do you think?
It was really interesting this week and today, especially even though flat price, managed to rally right throughout the day, actually, kind of recover. Calendar spreads were fairly unchanged at the end of the day. And when I say, let's talk June DEES and DEES, right? So the two big, so the June DEES calendar spread and the December 21, 22. And that tells me that there is some more buying in the back of the curve or less, sort of selling pressure, because the front didn't run, away more than the back. And generally, that's, when the front really, when spreads really blow up, right? You have June DEES and it goes from like $2 to $3.50, it would be the drone strike or, some short-term thing, right? So the front of the market is moving more than the back. But now a lot of, kind of what I'm seeing and what's different out there is that these spreads held firm. They were selling off this morning, but they kind of were unchanged with flat price up. And that says that maybe there's a little bit more interest in the value of the back further out on the curve, because we're not going to start. I mean, the infrastructure bill is not going to do anything tomorrow.
No. And it's going to take weeks and weeks before it even, has a chance of passing. But I'm just still anticipating that's what the market does, right? It projects what's going on.
And in that way, I'm saying, I think there was, you wouldn't look for that in the front of the market, right? But I think there was some evidence of that.
Okay.
In the back, maybe the way investment dollars are flowing or, but people waiting to hedge versus, a lot of times when the back moves up, calendar spreads can blow out more because people start selling the back, right? They'll sell next year's production, right? The hedge window is always a year or so out, right? They've already sold this year. Now they're going to look to sell Cal 22. And so a lot of times, like when the back popped up over $50, there was a lot of selling back there because producers were like, finally, right? So they locked that in. But there's been less pressure on that this week. And it's, I would say that has a little bit more fundamental bullishness to it. The complex, it would say, look, we may not have the production growth in the future. We are going to be investing a lot in infrastructure. We see this demand. And so the front doesn't deserve that big of a premium over the back.
So what about the opposite of, lockdowns and such? I mean, the EU's having trouble, Austria, Germany, Italy, France, some Scandinavian countries. And then here, CDC director the other day, very scared, that we're going to have a strong kind of wave because we're taking it too much for granted that the vaccines are going to, you know, resolve this sooner rather than later. So that type of alarm, if you will, we can see it in Europe. We can hear it here anyway. What's that do to the price of oil and the whole kind of your ability to analyze, because it's changing. It's also sentiment. There's so much.
Yeah, well, I mean, let's be real here. What happened last year, this sudden shutdown and, loss, within a matter of days, it seemed like, of demand that we were unprepared for is
Yep.
not the situation that we're in right now.
Correct.
We now know what lockdowns look like, right? We now know how to have things delivered, and it certainly won't be the same type of thing. And this, fear of this just massive collapse, it just doesn't, it seems like we've had a little practice for that now, right? We know how to take supply off the market. Refiners have been running at lower levels. So, I think it's all, the only thing these lockdowns serve to really do is make people question whether or not demand, like what month is demand really going to return to normal, right? Like we had thought maybe it was April, right? And now it's like, oh, some places in, Europe are closing, and Chile, closing its borders, some lockdowns, but it's certainly not everybody at the same time.
Mm-hmm.
We have the Olympics coming up, the Summer Olympics that were delayed last year.
I forgot completely about that as an event. Okay.
And look, the Olympics oftentimes has had
really
caused oil to rally. There's a lot of travel related to it. So, there are some things that are just different than last time, but certainly the more prolonged, this little pocket here, a little pocket there, it's just everybody's rolling their bullish bets further out on the curve. Everybody, wanted Jan Feb, and then not that. They wanted the Feb March, and then that came off. Everybody wanted, June Dece. And then June kind of started to sell off, and people are saying, okay, I want December versus December. It's just they're just constantly kind of rolling back into the curve how to time. And so there will be noise from now and, until we see if the US going to be locked down again, is, whatever, as that plays itself out. And I think what that will do is give you spots to get back into the spreads, right? If demand is a little weak and there's a sell-off in it, I think the market is going to be backwardated for a while. I mean, we have 8.1 million offline through April, right, from OPEC and Saudi Arabia. And after their additions, by the end of July, we'll still have 6 million offline. So in that way, it kind of keeps it structurally backward in that, we have less production now, but we kind of have this that can come back online at some point, and they're slowly dribbling it in. But in a sense, it's a put, right? Because if they notice the market going down too much, I mean, it's almost like the Fed, right? I mean, they'll pull back, whether or not, they can be effective, but there still is, you've got someone out there, they don't want them to fall either. Well, so I think.
Where were they in April last year? But just kidding. Okay.
Well, it happened so fast, I mean, who would have that? And that was really refiners. Just immediately backed off, and there were just a bunch of there's nothing they could have done.
So in that freak of nature event where oil went, negative and then whip-sawed back, any firms that you know of that were hurt really badly or taken out in body bags? I mean, that just they panicked at the low or what have you?
I mean, I would just say it was painful for a lot of people, and some people won. Honestly, that was, I don't think there was anybody that was positioned, for that.
One way or the other, for good or bad.
Yeah, so, not initially at least, but yeah,
But that's the market, that is surprising. I mean, to other onlookers, if you will. Oil's really just this. It's a government utility. It's not so interesting, and when you, look at that violent move last year. Oil's not supposed to move like Jagger, right? It's not supposed to move like that at all. So it was a lot of attention was paid, and a lot of deflationistas were out saying this is the end. We're going to crash the economy because we can't live like this, and it recovered, like you said, and it's stabilized. What then on the kind of macro front do you look at as part of your analysis, as it relates to the dollar, for example, or interest rates? The most recent kind of move since the Pfizer vaccine post election was inflation expectations running hotter and hotter, and CPI keeps getting pulled higher, yields pulled higher, commodities pulled higher. How much of that was oil, getting ahead of itself in from the fundamentals? And if we continue, and now it's stabilizing, like you said, we're kind of, in a range. But what if the macro starts to really drive more inflation expectations, higher CPI, gasoline consumption because of demand this summer keeps going up, up, up? Do you kind of work that into your model, or do you think that's transitory, as far as inflation? Influencing the price of, for example, crude because
at a macro level, crude, there's less money looking to go to work in crude oil, just in general,
What do you mean by that?
because of the ESG requirements and all of the different funds that have gotten out of oil investments.
Okay, so investments. Okay, yes.
Which is just less overall flows and reaction in the market. And in that way, that tied it closer to kind of inflationary type of, would react quicker to some of those macro themes. I think they still exist. I'm not sure, geez, if anyone who's traded natural gas the last few years, and you can just see the lack of performance and the lack of dollars willing to, commit further out on the curve. It's literally $2.50 as far as the eye can see. And, there's going to be a point where that macro theme makes the next replacement barrel more expensive. And that is probably not yet, because we have a lot of capacity sitting out there that can come onto the market. But at some point, you're going to have to start thinking about, if interest rates go up, the cost of holding oil, the cost to carry goes up. We've sort of been able to operate with none of those tones in the markets and let everything else, fluctuate for other reasons. And I think that, we may be approaching a point. I think right now it's just excited money for that narrative. I don't know that, it's actually playing itself out.
Well, maybe but you'll know it when you see it, type of thing, when you see the investment dollars coming in, because they can, they can see the potential of that. But I would also think that it would be very negative for the debt-ridden oil and gas companies that are already got hurt tremendously in kind of the oil recession of 2014 through 2016. So many went out of business. So how healthy are they, I guess, to absorb higher rates?
Well, a lot of the last 5 to 6 years has seen bankruptcies and liquidations. And in that way, you're almost like resetting the price of investment lower, right? So there's been a lot of acquisitions of, when someone goes into bankruptcy and they settle their debt for pennies on the dollar, the investment in that asset is, you just bought it for a much lower price. So there's been a lot that's, kind of been repriced, I would say. As always, I would imagine there are, individual companies that would be a problem for. I think the winners going forward are going to be those with the most flexibility, because the margins are coming from like renewable tax credits, creating biodiesel at a refinery and getting the $2 extra tax rebate instead of, the regular refining margin for producing distillates. So there's a lot of
Is that like the CVI, the
RIN, RINs, renewable identifier futures, they trade, right? So it's an obligation that a producer has. And anyone who produces biodiesel gets, a credit for having offset pollution, right, in the environment. And so, the ability to either be geographically located, the growth engine isn't the US. So you look at companies that are trying to place their refinery or their drilling in India, China, more in a better proximity to where the actual demand centers are, because we've seen time and time again that, transport is risky. You either don't get a pipeline built or you have a Suez Canal thing. Rates go up so much. I think last fall, or, before IMO 2020, certainly price, ship tanker rates, just went through the roof, and you have more risk on the sea now, or pirate activity. The higher price, the oil is, the more subject it is to pirate activity. So, and that's kind of a funny thing, but it is a real.
but it's an input cost. We got
that
to
exists.
consider it, like inflation expectations. That's more speculative. I mean, obviously the input costs matter, but I'm curious along that line of what would keep it over. I'm talking about crude over 65 for even a period of time, and where would it then start to turn and be a real headwind for economic growth, right? So right now it's okay, but at what price does it start to actually suppress demand because it gets too expensive and become a headwind to economic growth, which is a concern for the market?
Yeah, it's so funny because in like 2007, when oil was $140 a barrel, and then it crashed to 30.
Yeah.
But during that, gasoline prices were $5. I lived in Chicago at the time, so with city taxes and everything, they were insane. So right now, I mean, these are incredibly low gas prices. I think for the first time, I just paid over $3,
Yep.
which it's crazy that they're this low. So I think that was an objective that the last administration had, was to keep those prices low and reduce that tax on, the economy.
Yep.
I don't think this administration has, that same targets. So in that way, we might have more, ability to jump higher. But what would it take? I think we need to draw inventories down, more from here. We need to increase gasoline production and see that the market can take it. Refiners are running at the lowest levels they've ever been running at. They were, down to 60% after, the initial virus, kind of tried to ramp back up. And then that Texas winter freeze hit and they dropped, even lower levels. And so I think they made it back up to like 80%. 83% this week. And, we really need to see because that's the end demand for oil, right? Is, let's just say, gasoline and other refined products. Can we increase that production without crushing gasoline prices? I would say that's the big thing that everybody is really looking at. And we don't know yet.
Do you have any favorite, stock picking, if you will? which are your favorite refiners?
Oh, I don't trade energy equities. I just
Okay.
trade the outright. But I would
Underlying
say
Okay.
things that I would look for if I was trying to pick one, right, is
Mhm.
the flexibility of their, if to just have production in the Bakken, for example, right? The geography there is tough, as far as pipelines and getting you want somebody that has more exposure to, being able to convert their refinery and capitalize on some of these, green credits that are evolving and continuing to go up. The prices of these green credits just keep going up. So, someone who has flexibility to take advantage of that, or, is getting their production in a growth area, and the US is not really that growth area, right? So I think the theme really will be flexibility. Get the ones that can it's just no longer to just drill holes, only produce, and that's the only thing you do, right? Now going forward, it's going to be carbon capture and, who can green up their fleet quicker and cheaper.
Oh, Thomas has a question. Yeah. Um, can you see that question, by the way?
I sure do. Yep.
Okay, good.
Sounds like there is a genuine oops, I just lost it.
Uncertainty of demand more than a few months ahead. So, on the curve question, if you see this um, building up, will you? How do you position? Like, how do you manifest the trade, bullish or bearish? Right now, obviously, there's a bit of chop as it recovers, and as you
Mhm.
said, we had a really strong impulse, and it's tracked really beautifully also with inflation expectations and higher yields. So when you do, um, recommend or place a trade on the underlying, how do you manifest that trade? Do you do, you know,
So let's say you have let's take like right now, there's a bullish bias in the market for a lot of different reasons. And you can support that. You have people out there saying, Goldman likes to put their statements out there. So let's say you're starting with a bullish bias. You would look at some of the key calendar spreads. And like I said, summer versus winter, which a proxy of that is June versus December, right? You would expect that if the market really is that bullish and we are, going to run up against some, supply issues, you tend to want to come from the long side on these spreads, right? But, there's no straight line to the answer. So, that spread has been trading between 80 cents and I want to say it got up to over $3. In that way, how would I position for that? You would buy, when it's selling off and, wait for the pops. It's not outright long or short oil, because I don't actually really care where the price of oil goes. I just care that spread, if it widens out, it's more bullish. If it's coming in, right, it's, less bullish, or, and those reasons could be that there's more buying in the back. But so if your bias is long, you would always be looking at the particular calendar spreads and trading within their range. If we break 80 cents to the downside, and I mean, that spread was in contango 6 months ago, maybe less. So it needs to defend itself. We need to see the front of the market, and until it proves itself wrong, you're positioning on these relationships. And I know that's not like oil is going to this price or that price, but to be honest with you, it's the nature of these relationships that are trying to tell you when we think the demand recovery will hit. And you watch them roll out. And I post on, my Twitter most days, the curve of these calendar spreads, right? And you've seen it kind of, the peak of the 1 month calendar spreads keeps getting pushed further and further back. So is that the right thing? Are we just pushing them back, or do we have a day of reckoning happening here, right? Where we can't ever quite realize it.
Okay.
And so we're doing that work right now. The market is doing that work. And as a result, there's going to be a lot of swings, and battles on these spreads as the market is trying to figure out, what is the right relative value.
So we talk a little bit about gas at the pump, and it typically rises. There's some seasonality to it into the summer months. U.S. shale producers, are they likely to increase production if they want to off-site price, or no? Do you think they'll stay strained?
I mean, I would imagine we would, get back to pre-pandemic levels. I mean, that is what they do, right? They produce oil. So it will all depend on, how much capacity there is in the storage system. There was a huge backup in February in Pad 3, which is the Gulf Coast, as all the refiners shut in. And we built a lot of crude down there, and we need to clear that out. And that has to be cleared out either through it being refined or exported. And once that kind of gets out of there, there's more room in the system for, producers down there to start ramping up. And I mean, why wouldn't they?
And you watch jet fuel demand. I mean, it must be still cut in half where.
Yeah, it's just overall jet fuel is not a big percentage of, you got like gasoline at, let's say 50%, right? And jet fuel, it's not, I mean, certainly it'd be a nice kicker, right? To get that to happen. But, honestly, we have some things to clear out of the system. And once, and the market knows that, and it's kind of going up, going down, is this last inventory report that we came out, we didn't really see a big draw in crude, as to offset it. And so the market got nervous and came back off. But time and time again, it keeps getting bought, kind of down below 60, and, maybe it tries to hit 58. OPEC increasing today could be taken as a sign that they know the market needs it. I mean, India has been making a lot of noise about increasing gasoline prices. It's incredibly hard on that population. And so I think if we had a run up, it would be short-lived, right? Because there would be reaction. People would start zooming from home again, right? You know what I mean? Like and in that way, it can happen in the short term. And that's why people just keep kind of positioning long these spreads, because there's going to be an event, and you don't know, when the quote Saudi drone strike might happen, right? But what's the big deal to be long May, June at flat? That spread, right? It's like around flat. It's almost like a free option, if something happens and it jumps up to $1, right? If you look at the range it's traded in, right, it's kind of been +5, -5. So in that way, it's tactically looking at, these different relationships across the curve and starting to, build strategies, right? Like you buy a third of your position, as it dips, spreads dip, down its range, and then flip it back out. But it will be interesting to see prices at the pump, what impact that has, because there's more levers for people to pull now. They can, there's more EV options, for example, right? Electric vehicle options. There is not meeting in person options to, curtail immediately when you get that price signal. So I don't know. They'll be quick. I think spikes will be quick. And in that way, you want to be in them. And I just, putting on an option, like an upside option, you're just spending money and, waiting for it. You got to go almost like through your strike. It's easier to kind of play that through, calendar spread or calendar spread options. So there are a lot of transactions in like the 1 month calendar spread option, call or put. And those are, where, it's hard for me to translate that like into like a equity, a particular equity, right? Like ExxonMobil, because that's whether or not they're good at their business and they can continue to be the best cost provider, right? I mean, honestly, they all need to become the lowest cost producer. It's competition.
Well, Exxon's not going anywhere, so it's an easy one to trade, and it's very, liquid, and the option market is fabulous. So, I mean, there are some other integrated plays, but this is just easy. And the refiners, when the crack spread widens, and the oil market in general, when it goes from contango to backwardation, I mean, there's just some really nice general themes that I like to trade, and frame, if you will, with clients. But where it sits right now for me is waiting to see if the next 2 monthly prints of higher CPI, because we've had this big impulse higher in inflation, and it has been trading like a hedge. So oil has been trading like an inflation hedge. And I think that can continue to put some upward pressure. And so then I like to compare it with what you're seeing, right, in the curve, which is so helpful, because that's where the big money, and the transactions really reside. So you study that. So it's all very interesting from kind of like a market perspective. Place your bets, right? Higher, lower. Right now, we're in massive churn digestion, period. But no, it's good to get your live analysis, because it's always a little bit different from the written, which is so that's very helpful. Thank you for doing that, because I know that's also why people follow you, is for your insights on oil. One thing that we talked about kind of prior to getting together was, okay, let's take a look at the markets for sure, but then let's talk about how we can just be a face, if you will, of women in finance and trading, so that other women kind of know that we exist, so they can see what they can be, especially coming in to financial markets, whether to trade or analyze or run a book, whatever. What's some of the stories that you've had in kind of navigating this space, getting the attention, getting right kind of attention, and dueling it out to continue to be at the table, right, where you can have an impact. Not for nothing, but it is definitely hard to have them make that kind of awareness, if you will, that there needs to be more representation in the space. So how have you done in this regard? Because I definitely want to kind of get a flavor for that for others who are trying to navigate this as well.
It's interesting because there's a tenacity, required just in this industry, right? Just a tenacity that, you can't, someone has it or doesn't have it, right? And so I always think like, okay, is it, your ability to fight and for your place at the table, is that part of it? Right. But then there are, and I enjoy that, I think that tenacity, there's also just some fundamental disadvantages that exist. And maybe they don't as much today, but I guess they do. Look, wait, what am I saying? Look, always on a trade desk, there are, there's junior traders and senior traders and mid-level, and a majority are men. And, they have different interests and different ways that they get together. And it's that networking, that natural networking, like we both coach the same kids t-ball team because we're guys and we coach our sons, in t-ball, or, we're doing a quick round of golf after, whatever it is. And and those are just natural things in which some of the junior guys get just in the network and in the know and in the mix. And, it's hard to think about a recipe for just changing that, right? Just a bunch of women getting together, right? You're just segregating in that way.
And separate is not equal.
Right. I certainly don't have the answers, but I would say that it's not easy. And if you don't have the tenacity, it's probably not for you.
Well said. Yep. Curiosity, flexibility, and this grit, determination to keep going.
I remember one time getting interviewing. It was at a bank for a job, and essentially, giving me the offer with a really offensive salary that was basically meant, and they said, we just don't think you're quite fit into our culture. The culture being all guys on the desk, right? And the culture being, they like to do guy things. They like to fart on the desk, and they like to, chew and look at porn and whatever. And, the thing is, I just don't pay any attention to it, right? It's not my husband. So, but that's there. And that is the reality of it. And a lot of reasons there aren't more women in it is that they just don't happen to enjoy that environment.
Yeah, they don't want to put up with it. I hear you. Well, it is definitely, there are lots of changes, but I think there's still lots of improvement. And to kind of emphasize the reason why I wanted to do this, not just to get really good insights on the market, right? Get your take. And I run this every Tuesday and Thursday, and I have a lot of interest in finding out what makes the market move and how to learn more so I can be more effective for my clients. But I also definitely want to elevate and inspire and support women in trading and finance. And this is an opportunity to do so. So I really thank you for
thanks for having
accepting
me.
this invitation. We've got a great market perspective. I also want to, I will put the your site as well as Cornerstone and
Pictures. Yep.
All of that stuff will be on the description when I upload this to my YouTube channel. So that is you, and this is you.
All right. Well, I hope everybody is gearing up for a nice long weekend in the U.S. at least.
Yes, Passover and Easter.
Yep.
I get to also see my mother for the second time in a year.
So
she's got her vaccinations and she feels comfortable. It's kind of one of those things.
Yep. Well, that's good. Yeah, long weekend.
Risk averse. I haven't changed anything. I've gone out twice a week during the whole year. So
where are you located?
North of Boston.
Wow.
All right, so I've got them all in chat, and I will also list them when I upload this to my YouTube channel. So again, this is where it will reside in a little bit, and I thank you so much.
Thank you.
This has been very, very helpful to understand markets and also to see this grit and determination. You stuck with it. You're at the table. You're influencing many in this space that have sizable, positions, but also making an impact and having a voice for women. Thank you so much. I appreciate it.
I appreciate everyone joining. Thanks for having me. Have a good one.
Have a great long weekend. Bye.
Bye.